Hey everybody, I am Chris 70 with 70 Investments and coming to you with a live broadcast. I apologize if there's any glitches. First time us launching this live. But today I want to talk to you a little bit about what to expect in some of our live broadcasts and who we are. And today we'll talk actually about a case study to show you exactly what it is we do. So we invest in mortgage notes, and it's a very unique and niche industry within the real estate space. Many people have heard of either private lending or originating loans, but for us, we like to buy loans, specifically those that primarily are in default, meaning the borrowers are behind, and work with the borrower to get them on a payment plan, repaying, and sell that note. So if you've ever heard Lauren speak, we like to talk about that we fix and flip mortgage notes, similar to a house where you buy it that needs work, you fix it up, repair it, and then sell it for a premium. We do the same, but we're not buying the house. We're buying that individual's debt, which they then owe us the payments on the mortgage. We will work with them to try and rebuild their credit and get them repaying again, and then sell that loan back on the secondary market as an asset. As a performing asset. So let me dive right into a case study that we have. And here is a loan that is or was in Arizona. And the borrower on this property owed about $42,500. Oh, over $5,000 past due. And we were able to pick this up at a discount, about 70%, or a 30% discount. And this property had a ton of equity. It was over a $650,000 property. Now, a few things that people listening the first time will ask is, how does a borrower get so far behind in payments? In this one, actually, the borrower wasn't that far behind, honestly. In many instances, we see loans that are 12, 24, 36, 48 months behind, where the borrower hasn't paid their mortgage in that significant period of time. And that leads to a lot of questions of, why they can go that long. And many large institutions, they are not set up to deal with defaulted debt. So because of that, in many instances, they will look to offload it off of their books. So when we bid on this asset and did due diligence on it, every loan has a story. And when we're doing our due diligence, we like to look at what we call the 3 Ps: the person, the property, and the predicament. So let's first start with the property on this one. We will check the title report to make sure the lien position we're buying the loan in is still in that lien position and nothing has superseded it. There's no past due taxes or other types of liens that could impact the collectability of the note. So that is so important in note investing. When we get that title report, we send it to an attorney, and we also have the attorney confirm that we also have the ability to collect and potentially foreclose on this asset. That's important because, again, you want to make sure that you can collect this debt. The other part of the P, or property, is what does the property condition look like? Now, in this one, it's a small picture in the corner. You can see property looks to be in decent condition. The value of the land was actually worth more than the amount they owed on this loan, but the property was in great shape. So it was a borrower who took pride in the property. Next, we look at the person. And what does that mean? You look at the person. And what we do is we'll do public records checks on them. Have they filed bankruptcy 5 times? Have they have a criminal history? Are they in jail? What is this person's background? Because most people do not wake up one morning and they're like, oh, I'm not going to pay my mortgage today. That's not the first thing they think of. Usually they stop paying because typically there's either a death in the family, a divorce, which they're dual income. Now it's only one income can afford it. Disability or health, where somebody has a health condition where it causes them to absorb significant health bills. And last is job loss, whether temporary or permanent. So that is kind of, rolls into that last P of the predicament of what got them into this situation. And are they looking to try and get out of this situation and help themselves, or are they somebody who is being adversarial? So that's important to understand. And during our due diligence, we get to check on all these items. Now, what was unique about this loan was the prior lender had sent what's called loss mitigation packages. These also sometimes you hear called a shock package. It's a set of documents sent to the borrower, really like a loan application. Fill out information, provide your bank statements, provide your taxes, and kind of tell us the story of what happened. Do you want to keep the house? And, what are you proposing? Now, the interesting thing is in this situation, the banks sent a package in March and the borrower got it back in about 45 to 60 days, but then the bank sat on it for several months. And then when the bank finally got time to turn around and look at it, like, oh, the data's too old. We need another package. So then in January, they did the same thing. And basically this loan kept, going kind of round and round. And there was nothing in the file that indicated, any concerns about the borrower as part of our due diligence. So we acquired this loan in May of 2023 as a non-performing loan. And again, it was about 6 to 9 months delinquent. So it was less than a year, but more than the normal 90 or 120 days. And what we do is first we have the servicer, who's a company acts on our behalf, who's licensed in that state, go out and, send or try and contact them. So let me back up a little bit and talk a little bit more about a servicing company. You have a mortgage. You typically will send your payments not to the bank, but actually to the servicer. And they're responsible for sending you your statements, collecting the escrow, doing your escrow analysis, sending you your tax forms. Now, most banks and institutions don't do that. They let third-party companies handle that. And many times you might get a letter in the mail that says, hey, now you need to send your payment to this address. Typically, that's because your loan was sold. So just want to kind of give you a little bit of background about the servicer. We're not the ones physically reaching out, contacting the borrowers. That servicer, and if you've owned property as a rental, kind of acts as like the property manager. So they're the note manager for us, where they'll make the phone calls, but they don't make the decisions. So they'll act upon what we want them to do. In many instances, the server is unsuccessful contacting the borrower. The borrower's behind. They see somebody calling. They know I don't have the money, whatnot, kind of out of sight, out of mind. So we will send what's called demand letter. And we sent one in June. That's a letter from an attorney that demands the amount due, the $5,600, or we might look to foreclose on your property. We sent the demand. They did not respond. So we set the foreclosure date for December of 2023. Arizona is what's called a non-judicial state. So it doesn't have to go through a court. So foreclosure timelines, as you can see, pretty quick in this state. Well, usually the demand letter or the foreclosure notice, that gets people's ears perked. And in this instance, the borrower stepped up knowing there was a foreclosure date and sent us a payment of $8,000 in November, which reinstated the loan. So the loan is now brought current. Now, when they do that, you no longer can foreclose on that borrower because they've caught up and made all their payments, which is what we want them to do. Our goal is not to foreclose on these assets. And it's actually rare that we do foreclose. If I looked at our portfolio, it's under 10% of the time. And it's typically because they don't want the property, or unfortunately, the people passed away. So after they made that large payment, the borrower continued to make their other payments. They made their December, January, February payment. And part of our portfolio, as loans start to get performing again or reperforming, we'll turn around and look to sell that back on the secondary market. Now, when you go back and sell that on the market, when the borrower is in a performing state, they'll still sell at a discount, but not as significant a discount. So in this instance, we end up selling it for, little more than what we paid for it. But then when you take into account all of those payments that we had, we ended up making over $10,000 on this loan. So wanted to share this case study for people because I thought it was important for people to understand and see what the process looks like. Now, during this process, you do have to recognize and understand you have costs involved. You have the cost of your servicer, who can be anywhere from $35 to $100 a month, depending on where the loan is. Sending a demand letter and filing foreclosures, those also have costs involved, which many instances you can recollect them for the borrower, but it's things to be consider if you are buying notes, because not every borrower will turn around and reperform. So I hope you enjoyed this webinar / live broadcast on our case study. If you would like to have more videos like this, subscribe on our YouTube channel. And thank you all for watching, and check us out for more videos.